All right. Good morning. Good morning. It's nice to see everybody here. We got a nice little crowd sitting here waiting to get started first thing in the morning. And we got something fun to talk about today. And Chad will be happy. We got something new to learn. Not that we don't learn something new every single day, but we do have something fun to look at today. It was brought to my attention about a new company. Well, I guess they're not a new company, but about some new funds, new ETFs, single stock ETFs, very similar to the YieldMax funds. Now, those of you who have been attending my classes on a regular basis know that I'm quite fond of the YieldMax funds. In fact, I have a pretty nice little portfolio. Actually, two of my accounts are concentrated quite heavily into the YieldMax funds. And I've got a buddy from high school that has really gotten into this with me, and the two of us talk a lot about this, and he's quite a research nerd, more so than me even, and he's been really kind of grabbed onto this with both teeth. Is that how old we are? Grabbed onto this and like a bulldog, and has really been doing a lot of research. And he came across this other company that has some YieldMax style funds, some single stock ETFs that they've just released. And he brought those to my attention, and I want to share them with you today. Now, I've looked at them just a little bit, and I thought, you know what? I don't want to spoil the discovery. So I didn't go and do a whole lot of research into them. I did a little, enough to realize that, hey, these are pretty cool. And I wanted to do that discovery with you. How's that sound? So I didn't want to go in and look at them and do too much research so that I could see them the same time as you guys did. And maybe some of you know about them, but I didn't know about them. They're relatively new. So I wanted to have the surprise of, hey, this is pretty cool, and the discovery and my first impressions online with you guys here in class. So let's go take a look at them. All right, shall we? First of all, let's talk a little bit as an introduction. Let's drop this down here. We're going to talk just first about the YieldMax funds and give you just a little back history about how I come down this path to the YieldMax funds. Now, my background comes from the futures market over in Chicago, not from the New York exchange. So a lot of the stuff in the New York market, I mean, although not really new to me, it's new to me. All right. So the New York market is fun for me to explore, and I see exciting things happening in it. It's so big. I mean, the financial markets are so big and so varied and so wide. You know, not any one guy can know everything. I've been doing this for 40 years, almost 40 years, and I don't, by any stretch of the imagination, know everything. I still discover and learn new stuff every single day. So I'm always trying to research new things. And there's a lot I don't know. And the more I learn, the more I learn I don't know. And so one of the historical things, or something I do know about, is that we had over in the futures market, we tried to do single stock futures. And maybe some of you know and remember back in those days when single stock futures was a thing. And they tried to do single stock futures in the futures market over in Chicago. Now, those of you who know a little bit about the Chicago exchanges know that they're primarily focused around commodities, so corn, wheat, and soybeans. Now, gold, silver, crude oil, those types of things, cattle, pigs, pork bellies, right? Orange juice, what's some other famous ones? Cotton, right? Sugar. Those are the types of things that we used to trade all the time. And a lot of fun. Enjoyed them. Trading corn, that was a popular one. But they also have the indexes. All right. So the Qs, like the NASDAQ, the S&P 500, the Dow, the Russell 2000. So there's indexes. And I like to day trade the indexes. That's my favorite thing to do. But over in the futures market in Chicago, we didn't have individual stocks, right? Those were left to the New York exchanges. But in the spirit of competition, the Chicago exchanges at one point tried to do single stock futures, which is really a cool idea. I was so excited about it. I couldn't stand it. I started writing software around it. We started developing for it. We were putting it into our software, the track and trade trading platform at the time. And we were really going headlong into going to have a version of our track and trade software for single stock futures. It was so cool. I was so excited about it. And we started to look into it. I started to trade them a little bit, getting familiar with them. The volume never picked up because I was on the education circuit at the time for the futures market. I was teaching single stock futures. I was introducing them to people during our seminar series. So single stock futures was quite a big thing. And then of course we couldn't get anybody to trade them. Nobody traded them. So they shut them down. And it was a sad day for me. I had spent a lot of money developing software to trade the single stock futures, and I had invested a lot of money into it, and I'd started to trade them and start to get pretty comfortable with them and happy with them, and they died. So what is a single stock future? Well, a single stock future is the ability to have a single stock like Apple or Amazon or Netflix or Google or something like that over in the futures exchange where everything is traded on margin. So you would run a margin account, and you didn't have all the rules and all the regulations that you have over in the stock market. So you didn't have pattern day trading rules. You didn't have all that stuff, right? Didn't have to have a $25,000 account to day trade it. You had this high leverage. It was out of the futures market. It was just a neat thing. All right. And they closed it down. And so now we go back over to here's what, 20 years later. Here we are over in the stock market, and some wise guy comes up and he goes, we got these things over here in the stock market called ETFs, or exchange traded funds. And exchange traded funds is exactly what it sounds like. It's a fund that has multiple stocks in it. All right. It's a fund. It's like a basket of stocks. They call them ETFs, exchange traded funds. Now, what's the difference between a mutual fund, which is a basket of stocks, a stock fund, or an ETF? Well, a mutual fund trades, and you can only trade it once a day. They give you the closing value, and that's it. That's all you have. You have the closing value. Well, they decided to say, well, why don't we have these ETFs, exchange traded funds, where they can build these funds, these baskets of stocks, and they can trade them all day long, just like they do a normal stock. So you just buy one symbol, and you can, in essence, be actually trading a diversified trading account. It was a great new invention. All right. Oh, this is exciting. So they come and put together these ETFs, exchange trade funds. And then some wise guy comes along and he says, why can't I have a single stock ETF? Very similar to what they were doing over in the, what we were doing over there in Chicago with our single stock futures. So a single stock ETF is very similar to this idea of the single stock futures. The difference is over in the stock exchange where people like to trade stocks. Okay, stocks is a great thing. We like to trade stocks in the stock exchange. It was hard to get people to trade stocks in the futures exchange. Didn't quite meld. But this wise guy, Jay Petrocelli was his name, founded YieldMax, and he started these single stock, not futures, but single stock ETFs. So it doesn't make sense, almost like an oxymoron, where you have an exchange traded fund, right, which is supposed to be a basket of stocks giving you the diversification into one stock symbol. So you buy one stock symbol and you have all these stocks, and then you can trade them. Like you could day trade them, right? If you wanted to, you could trade this one symbol and you're day trading all the stocks simultaneously. So he takes that idea and he turns it around and he says, I want to have an ETF, an exchange traded fund that only trades one stock. And everybody's like, why would you do that? That's a dumb idea. He's like, because I ain't going to trade it. I'm going to invest in it, or I'm going to trade it with options. I'm going to trade options on it. And so he started putting together a strategy, one of his favorite trading strategies, which is, I call them bull call spreads with a naked leg. But a bull call spread with a naked leg. But we put the naked leg right directly on top of the long call. So it ends up becoming a synthetic long, or another thing, we call it a free trade, a synthetic long with a bull call spread, or with a covered call. All right. So the covered call makes money because you're selling the premium and collecting premium. Those of you who like to sell premium and options premium, I love selling options premium. It's one of the ways I've traded my portfolio, made the most money in my portfolio for years. That's my kind of favorite thing. I like to sell premium and collect premium. I've made more money selling premium and collecting premium than I had buying options and trying to, capture big long runs in the market and have a big explosive growth. So I've had better returns selling premium. And so when YieldMax is Jay Petrocelli comes along and says, hey, I'm going to have an ETF and a single stock ETF. And I'm thinking back in my world, well, we had single stock futures and I loved them. He wants to do a single stock ETF, but to create the income that comes from that, he's not going to have it be a basket of stocks. He's going to have it be a one stock, and he's going to trade options on it. And he's going to do one of my favorite strategies, which is bull call spread with a naked leg. Oh my gosh, this is cool as can be. Cool as cucumbers, right? So I got really excited about it. Now, are there better ways to make money? I want to have that little discussion too. Some people get, I wanted to use the word petrified, but petrified isn't really the word. What's the word when you don't dare do anything because you don't want to do it wrong, right? So you don't do anything at all. You get, I don't know, what's that word I'm looking for? So anyway, you get petrified. Let's use the word petrified. It works for me. All right. You get petrified. So you don't want to, you're like, well, I've heard other people say that doing this will make more money than this. And so I'm not going to do either one because I don't know what to do. Or you kind of you start to do this thing where you jump around, and we see it in people who are using indicators. They're always looking for the holy grail, right? Oh, this indicator, that indicator, I got the best indicator in the world. There used to be a company that would come out and they're like, we're going to send you a new indicator every week. And as the weekly indicator, you get this new indicator. I'm like, oh, eventually you're going to realize that there's only about 8 indicators in the whole world that actually work. And all the rest of them are just derivatives of those eight indicators. You change the little math formula here or there and just kind of get a derivative of the same indicator. And after a while, there's, indicators are nothing more than moving averages. After a while, there's only so many ways you can look at a moving average. And so I was like, well, that's a short-lived company. And they lasted for about 3 or 4 months, and then they were done because they run out of indicators. It's like, well, okay, what indicator are we going to give them for free this year, this week? It was like, that was kind of a silly idea, in my opinion. I mean, they did quite well for the first little while because, everybody wants a new indicator. I'm going to get this new indicator. And you go out in some of these online, companies that have indicators, there's 10 million of them. But again, after you start looking at them, you realize that most of them are exactly the same. They're just some variation, or they change the colors, or they turn them upside down and call them something else. It just stupid things like that. When you become a developer and you're developing trading software and you have to put indicators into your software like we did, you start researching this very deeply to the point of, well, I know exactly what they're doing and how this is done. It's, you can't fool me by changing a color anymore. You start to realize that most of it's just a bunch of BS, and it's just, they're just doing it to write a book or sell something, or, it's just a variation on a theme. Well, this indicator didn't give me a buy signal in this situation, but it gave me a buy signal in this situation. So I want to create the indicator to give me a buy signal in this situation. Okay, well, you get a buy signal in this situation, but then it doesn't give you the buy signal in this situation. So you end up with just a variation on a theme. It's the same indicator. It's just changed a little bit so that the buy signal went from this spot to this spot. But now you don't have the buy signal over here. You have it over here. Well, it's a different indicator. Okay, well, rename it and call it something new. Make yourself famous. That's mostly what it's about. So anyway, getting off track here a little bit. Let's weave this back into the commentary that we're looking for here. These YieldMax funds came out with these single stock futures, and he started trading options on them. So what happens is you end up with a fund that you invest in, and you don't, and the point is, well, why would I invest in, Amazon, YieldMax Amazon ETF, if I can just invest in Amazon directly? Well, because he's not going to go over and buy the Amazon stock like a traditional ETF would. He's going to trade options on that stock for you, on your behalf, basically, right? He's going to trade the options for you. Now, coming from a world where I like to trade options, Heck, somebody who's really good at trading options is going to trade the options for me. I was kind of like, okay, I'll give that a shot. See if you can beat me. See if you can trade options better than I can, make more money than I can. Now, again, it comes back to that question is like, well, I don't really want to do this because I heard that I can make more money doing something else. Or I heard that I can make more money doing something else. You go out and watch these YouTube channels of guys who will sit here and sort down through all of these ETFs, right? And they're like, which one's the best? And this is the best one. And it came out with this mathematical model and formula that says this is the best, or that's the best. And this is the one you should be in. And this will make you the most money. And then you find out a year later that that one didn't make the most money. Why? Because hindsight's, 2020 and past performance isn't necessarily indicative of future results. So the list is constantly changing. What is the best? What's on top? What's going to be the best? You're constantly changing, chasing the best. And so you really never settle into anything and just kind of concentrate on it and become good at one thing. And I believe personally that when I've become a specialist or an expert in one thing, I've been able to do it well and make more money doing that one thing, even though it might not be as much money as somebody else is making doing something else. All right. Which is their good thing. All right. Or by bouncing around and always chasing the best thing. Oh, that thing's making more money this month than mine is. I'm going to put my money over there. Oh, that thing's now making more money over there. I'm going to put my money over there. Oh, I'm going to roll it over here. I'm going to roll it over there. I'm going to roll it over there. Constantly jumping in and out of markets, chasing the best returns. I've learned that that's not the best way to trade. The best way to trade is to kind of concentrate, focus on your expertise. Now, I got really good at options. I like to trade options. I like to reverse engineer, as we talked about, the mathematical algorithms that the big banks and hedge funds trade. So we have a model that we use to try and reverse engineer that, right? And that's a large part of what we do in this class. We come here and reverse engineer those formulas. And so in the process of reverse engineering those formulas, we trade against those models. And then I like to trade options to do that. So is there ways to make more money other ways? Yeah, I see guys beat me all the time. I'm not the best trader in the world, but I'm pretty good. I do okay. And I like the way I do it. I'm comfortable with it. And then when I find these YieldMax funds and they're doing the same thing I am in a kind of a unique way, I'm like, hey, I want to participate in that too. Doesn't mean I stop trading options myself. It just means I kind of put some money over here in the YieldMax funds, which do kind of something weird, which is a single stock ETF, which is very similar to my, back history, which comes from single stock futures. And that's where YieldMax came into play. They're the ones who came up with this idea to do these single stock ETFs. Now, that said, I want to go over, and there's another company now that's copying these. Now, there's several. But I'm not going to go and talk about all of them. I'm going to talk about just this new one that we found. But I want to come over, and before I do that, I want to come over to this little program here called FinViz, and I want to pull up this. And for example, let's pull up Tesla. TSLY is their symbol. Now that the normal symbol for Tesla is TSLA, and I'm disappointed in Tesla lately because Elon's gotten involved. Elon is kind of, obviously everybody knows Elon. He's the face of Tesla. And, he at one point was very big on the left and, we're going to save the world with electric cars and all that kind of stuff. So he got very political, and all the left people, they loved him and they were buying his cars and he was doing really well. And then, of course, he decided that he wanted to back Donald Trump, and he got political, and then all the left people hated him and all the right people loved him. And then he got in a fight with Donald Trump, and now neither the right or the left like him. So being the face of Tesla, he's kind of shot himself in the foot, and nobody's buying his cars anymore. So unfortunately, it's not like nobody's buying his cars. He's still making them. He's still selling them as fast as he can make them. But people aren't really buying his stock as much anymore. His stock hasn't exploded like I kind of thought it was going to. Doesn't mean it still can. He's still got some things, rolling out. He's kind of, he's still doing the political thing. So both parties hate him now. I'm going to start my own party. I'm not going to be a Democrat or a Republican. So now the Republicans hate him. Now the Democrats hate him. Who's buying his cars? That's the question I want to know. Everybody hates Elon now. Not that you hate him. I really think he's an amazing guy, and but he's got political. Same thing happened to Donald Trump. Donald Trump was making all this money with his golf courses, and everybody wanted to go to the Trump Tower, and stay. Oh, we're going to go to a Trump golf course or whatever. People like that kind of thing, right? And then he became political, and half the country, half the world decided they didn't want to go to Trump stuff anymore. So he lost billions of dollars in value, right, by becoming political. It's what happens. You become political, and half the world doesn't like you. So the point that I wanted to make here is that when we go down to Tesla, I got to circle back around and get back on track. So that's my point with Tesla. I'm just a little disappointed. I have a lot of money in Tesla, and that's kind of my frustration. Is I have a lot of money in it. And is it still making me money? Yeah, it's making money because we're trading bull call spreads on it with a naked leg, right? So we're collecting premium. It's just not as much as we could be making. I wish it was making more money, right? I wish Tesla go up a little bit. The bull call spread with a naked leg actually makes more money if the market rises. Doesn't mean it doesn't make money when a market goes sideways. It certainly does, because we're selling premium and we're still collecting that premium, and we still get that income from premium. But if the market rises, we also get the increase in value. And the reason I'm bringing this up is because the new company doesn't do that. All right. The new company doesn't do that. So there's a difference between how they trade, even though they both trade options on single stock futures, or not single stock futures, single stock ETFs. But when we come into Tesla, now I'm going to take you over to Tesla, TSLY, which is the YieldMax version of Tesla. Right now, this is the YieldMax version of Tesla. So if you want to get the dividends, the premium, the distributions that come from selling options on Tesla, you put your money in here, and then they'll use your money to back their options premiums, and then every month they pay you whatever they earned in options as a dividend. It's not a real dividend. A dividend is, technically speaking, profits from the shares, from the profits of the sales of the company, right? The company does well, they sell a bunch of Apple iPhones or something, they can pay you a dividend. Now, usually you would think that would go up and down, but traditionally speaking, they pay out quarterly, and it's usually, the exact same thing every month. This is such a tiny, piddly little amount that oftentimes, if you're trading the stock, you don't really care about the dividend, because the dividend is so small that the asset value, the movement of the value of the stock far outperforms the value of the dividend. And so we oftentimes say, don't trade a stock for the dividends, because the underlying premium of the option, the underlying value of the stock itself is going to far outweigh the movement of whatever little dinky dividend they give you. Not that their dividends are not important, they are, and you can see, and we're writing I got an article coming out in Pitt News Magazine where we show the difference of trading for the value of the stock only and not including the dividends, and then having the dividends included in. And it's a significant jump to have the dividends included in. You definitely want the dividends. I'm not saying not to. I'm just saying that the value of the stock increases and decreases, and we don't really want to be making our trading decisions based on whether we're going to get the dividend or not, because it's the value, the movement of the stock can outperform that in a snap of the fingers. So, all right. So, but that's not the case over here in Tesla, or in these YieldMax funds. The dividend is not a dividend. It's actually a payment of the premium that's being received by trading the options. So it's much higher. Okay. It's more of a distribution than it is a dividend. And so it's just, it's a way of trading and making money. Now, is there better ways to make money? Can you make money? The question is, can you make more money trading other methods other than selling premium on options? Yes, you can. And that's well known. If you come to me and say, Lan, forget about YieldMax, forget about this other company, forget about all this dividend stuff. If I'm just going to trade, is the most profitable trading method selling premium? No, probably not. I mean, if you catch a nice trend on a long call, man, you're gonna, and Dr. Brown will tell you this all day long, because that's what he trades. He just long calls, the only thing he trades, and he makes a lot of money. He loses a lot of money too, but overall he makes a lot of money, and he's done quite well over the years just doing long calls. And he's a PhD. He does all of this academic research, and he'll tell you that, strictly speaking, that the long call is the most profitable method of trading options. Have I had the best luck trading long calls? No, I do better trading, selling premium. I've made more money selling premium. So I like to sell premium. Doesn't mean that somebody else can't make more money doing something else. And that's the point I'm trying to make. You got to just pick something that you're comfortable with and something that works for you, and do that. whether it's the thing that makes the most money in the whole world, or whether it's the best indicator in the whole world, or whether it's the best stock in the whole world. I got to just have everything that's the best in the whole world. And whatever that best is can be calculated in many different ways to tell you that what you're doing is not the best. And so we become petrified, to use a term that's not exactly perfect, but we become petrified in the sense that we don't do anything, or we don't want to do it because we're constantly jumping around and we're not doing anything. Or we're always feeling like there's something else out there that can make me more money, and I got to go find that thing. All right. I don't agree. My logic that I'm trying to circle here and get across is that I don't agree. I think that the best thing for you to do is do something that works for you and seems to be working well for you, and just do that, and not sit there and compare yourself against something else or somebody else, or historical, trading examples that, oh, if I would have done that, I'd have made a lot much more money. Oh, if I would have done this, oh, if I'd had my money in that stock instead of this stock, I'd be much more richer. You can drive yourself absolutely batty and nuts doing that. And I've learned that too, because ask me how I know. I've been there, done that. All right. And over the last year, I've been very happy trading the YieldMax funds. And the reason I've been very happy is because it's something I know, it's something I understand. I understand options. I understand the world of the single stock futures. I came from that world. And then this world is very similar to that, in the sense that it's a single stock ETF, but they're trading options on the single stock ETF to produce the income. I like that. That's the way I like to trade. Is it the way that's going to make the most money overall? No, there's other ways to make money. Dr. Brown makes more money than I do. If you want to go talk to Dr. Brown, you can. He's scottbrownphd.com. He uses track and trade. He's part of the family. He's one of our mentors here at Trade Mentors. He's my buddy, pal, and fellow trader. So he writes for Pit News Magazine. He's one of the great guys that we love, and he makes more money than I do trading long calls. If you want to go and join his he doesn't have a YouTube channel. He does Zoom calls, and you have to pay him to go watch him trade. And he sits there and analyzes the markets and tells you what he's going to do. And you can do that. And I would encourage you to do that. Go ahead, go join Scott Brown. He's really good at what he does. Makes more money than I do. All right. But he just does long calls. That's all he does. Buys options, buys long calls, analyzes markets, looks at them, puts his order in. Away you go. All right. So just do that if you want. But I like the selling premium. I've made more money selling premium than I have buying long calls. Doc Brown's good at long calls. I'm better at selling premium. I like to do one thing. He likes to do another thing. Does his method make more money than mine? Yep, he has. He's proven to make more money than me. He's also proven to lose more money than me. All right. He has bigger swings than I do. I'm more stable than he is. And in my stability, I like that. For me, that works well. He's okay with the big swings because he knows it'll come back. Yeah, I'll get it back. I'm not worried. I just lost 80 grand today. It's all right. Tomorrow I'll do better. Right. So that's okay for him, but it hurts for me. I'm not the big fan of that. So I like these YieldMax funds because they do what I do, and they do it for me, and I understand them, and I've studied them really hard, and I've gotten good at them. All right. You still have to trade them. It's not like it's free money. You still have to be wise about what you're doing and how you interject your money and follow it and track it and do it. You see my spreadsheet. When I track my spreadsheet, this is it right now. This is my current spreadsheet. I'll show you. This is real money. All right. This is my real money spreadsheet. I have a disclaimer at the beginning of my class. It says, this is a class. It's an educational environment, and everything we do here is in the demo account unless I specifically tell you that it's real money. So here I am specifically telling you this is my real money account. And I started with 476,000. You can see here my current profit and loss. That was last July 2024. And as of today, which is mid-July, 15, I'm up $338,000. So I've done okay. Has Doc Brown outperformed me? Yep, he has. He's made more than that this year. All right. I think he started with more, but nonetheless, I don't know what his percentage gains are, but mine's at 71%. And I'm happy with that. 71% return on my money in 1 year. I'm pretty happy with that. All right. Is it the best? No, there's guys that can beat me. Is there another thing I could run off and try and do that'll maybe beat and do better than 71% next year? There are probably things that I could go do on my own, but this is letting somebody else trade for me doing the yield. And this is just one of my accounts, right? I have another one over here. This is my IRA, and you can see it's up 39%. All right. Started with 172,000. Now this is just for the year. So I'm 39% just in the year 2025. This account, and that, so 39% so far this year. This account is 1 year. It starts, this 476 started in July of last year. So different timing, different starting point of the timing. I'm going to reset this one in January 2026, and we'll redo it and start it in January 2026 and see how it does. All right. But that's real money. That's how I'm doing real money. And I'm happy with that. I can't complain about that. Could I do something, make more money? Yeah, I probably could. Now, what I want to do is I want to show you that's the YieldMax stuff. Now, this is YieldMax. I'm going to come down here, TSLY, and I'm going to come down here and show you what they've invested your money in. So if you give your money to TSLY, you give it to YieldMax and put it into the TSLI fund, this is what they're going to invest it in. Notice that the majority of it is just in bonds. 46% is in 3.875% bonds. This is the Treasury notes. They've got 17% are in Treasury notes. So the thing is that they're actually, believe it or not, very conservative on what they're investing your money in. Then here's T-bills. They got 13% of your money just goes into T-bills and just collects the interest that they're making there, right? They share that with you. We're going to skip over Tesla. Well, actually, there's Tesla right there. I was going to skip over and say, look, Treasury bond notes 3%, and this is at 9%. Treasury bills at 4%. And now here's where you're getting into where they're investing in Tesla. So they got Tesla. This is a call, 290 call. Right now, they've got 9.79%. All right, hold on a second. I'm losing my voice. Make sure my microphone's back on and working. It says it is, so I guess we can continue. All right, so you can see down here they got Tesla. This is in some more calls, 4%. Here's some puts right here, 3%. United States Treasury bills, again, another 7%. Here's some more Tesla put options, 1%. Percentage of portfolio on the 10 top holdings, 102%. I don't know how they get 102%, but they do. So anyway, nonetheless, you can see the most of what they're investing in is the bonds and the Treasury notes, right? Government bonds and Treasury notes. It's a very small percentage of this is actually being traded in the actual underlying Tesla fund itself. So it's just an interesting way of doing it. So it's quite a conservative method of trading in reality, because although it is a single stock ETF in being invested in a single stock, it's actually not. It's actually mostly invested in bonds and T-notes, which is generally considered pretty conservative trading. But then they go and do this very, more advanced trading with options. And that's where the income comes from. So you can see that that's the top 10 holdings of the Tesla fund. Now, the reason I bring that up is because we're going to go over, and now we're going to go over and we're going to compare to what's going on with this new company. And I want to show you their fund. And we're going to go take a look at this. I haven't done that yet. I want to do that with you guys. So I want to see what's going on. This is the news, and that's about it. That's all they've got here. All right. So that's Tesla. That's the YieldMax fund. That's a little bit of history. That's where it comes from. YieldMax has a bunch of different stocks, not just Tesla. In fact, I have my little calculator pulled up in here. I pulled it up the other day and it had an error in it. Grok 4 came out and I stuck it into Grok 4 and I said, what's wrong with my calculator? And it told me that, and I did it. Believe it or not, I had an error in this, and you guys saw it who were with me last week in my little calculator that I've been working here. And it was 10 minutes before class was going to start. And I'm like, oh no, my calculator doesn't work. There's an error in it. I took all the files, the computer programming files. I uploaded them to Grok, which is Elon's AI system, right? I uploaded it to Grok and I said, what's wrong with my calculator? And that fast, it came back and told me what was wrong. And I fixed it 10 minutes before class started because I had Grok tell me what was wrong with the calculator, and we were able to go in and fix it. Now, I haven't run it since he fixed it. So I haven't run it, but I wanted to run it here and let's see, because I wanted to show you, and it worked. So I wanted to show you all the different funds that this YieldMax company you can invest in. All right. So the top one on the list right now that's returning the largest return, which is 111% return. Now that's not a dividend. It's not a traditional dividend. They're trading options, and that's how much money they made in the last 12 months in options trading. They've been able to return 111% return on their options investment. All right. Now I have some NVIDIA. So let's pull up my spreadsheet again. Where did it go? It's a little slow over here. Let's go look at my NVIDIA. So they're saying NVIDIA is top on the list. Let's come and look. Palantir, Misty, Snoy, NVIDIA right here. So this little box right here tells me my NVIDIA. And you can see that I've got invested. I started with 42,000. And then in 2024, I invested 42,000. And starting 2025, I started to add more money. Now, this was some of it, I don't know. I've got blended money in here. So you can't really come in and say, well, how much did you start off with versus how much did you reinvest? So I just cut it off and said, this is how much I put in July. And then I broke it down into each individual stock, how much I put in just in the year of 2024 versus 2025. So that's what I call it parity and cash cow and gravy train. I've given them funny names. Really, it's just break evens. All right. But it's different break even levels. All right. So here we come. This is NVIDIA. You can see right now I've got $65,000 in NVIDIA. 42,000 of that came, I think, from McDonald's money. And I call it McDonald's money, meaning money that I put into it. But I can see up here by looking in the formula that I've got all these things. I put 20,000 in first, and then took out 17,000 and added 3,000, 1,000, took out 4,000. See, when I first started, I was trading it. I didn't know. And then we started going in, and then there I put in 25,000, and then I put in 5,000, then I put 52,000, 5,000. If I were to guess, which I can't do, I would imagine the 25,000 was probably, well, it was blended money. So I don't know. I don't have a starting number. And so that's why you can't really come in and say, well, did you get all your money back at what point? Well, because most of it's blended money. It's money that I'm reinvesting that I already got. It's like profits reinvested. Okay. But anyway, I'm going to say that it's 42,000 because of 2024. And then I've added this much in here for 2025. So you can see in here that I have a total invested of 65,000. And these are the payments they've been giving me. So in 2024, they gave me $900, but everything else is in 2025, starting in January. So you can see I've been averaging pretty good money. And you can see that right up in here. This is NVIDIA right here. This is my NVIDIA line. So I've been averaging with my $65,000 investment, $2,921 a month on average. You can see that it changes every month because they make more money some months, they make less money some months. So this is 2,800, this is 3,600. Those are purple just because I put that on there just for fun, just to say, well, that's how much I have to pay for the first 2 months. I'll have to go to taxes. So 31 and 26,000. So the first month in January, I made $31,000 in my portfolio. In February, I made $26,000 in my portfolio. That'd be pretty nice, right? To be able to say, well, I make about $30,000 a month. A lot of people say I make about $30,000 a year. But this portfolio of mine, this one portfolio, the individual account has made this in January, made 31,000. And then in February, I made 26,000. So I add those two together, and that's my taxes. Now I get to keep this. 27,000 in March. April, I made 30,000. May, I made 53,000. June, I made 31,000. And right now, so far this month of July, I've made 9,000. I've still got 4 more payments to come to me. So it should be, I'm on track to make about 40,000. It'll probably be closer to this one here, June. I'm imagining it'll probably be closer. I might even be a little bit less. My projections are telling me I might get a little bit less than June. So it might be less than 30,000. June and July, this is middle of the summertime, so the volatility is not very high. And the way these options, these funds make money is because they make money by having volatility in the market. You need to have a lot of volatility, and the markets haven't been very volatile lately. I mean, go look at the S&P 500. Look at this. Let's pull up the S&P very quickly here. Where's my trading platform gone? There it is. So let's pull up the S&P 500, SPY, which I wanted to kind of run through for you really quick here anyway, make some projections. Now, we got some very interesting things going on with the S&P. So you can see we're in a 3-drive pattern for those of you who've been following along, and you know what that means. This is drive 1. We got a counter trend. This is drive 2. We got a counter trend. This is drive 3. So this is a scary moment in here because we generally get an ABC retracement off the peak right up in here. So I wouldn't be buyers right up in here. I'm not buying anything right now. But this is a X3A1S. So that's, this little blue light. When it crosses the blue light, we're going to anticipate a fall in price. Right now, we're looking at a target down in here of 604.95, 595, and ultimately down to 576. Right. So that would be our 38.2 is where things are set right now. Now, there might be some changes because if they get rid of the great Fed chair and they bring in somebody who lowers interest rates, I think we could see we might go into a fourth drive, or this third drive might just extend and just keep right on going. Nice big fourth drive. I don't know. So our third drive. So we're going to wait and see, because the fundamentals do make some changes, but for the most part, the algorithm says we're at the top of the third drive, which we all know that the probability of that going much higher is pretty low. All right. It doesn't mean it can't. It can go up to a 4, 5, 6, 7, 8, 9, 10 drive. It's just very, very, very rare. So by the time we get up into this third drive, we start getting a little nervous. We want this pullback so we can buy in and start going to another drive, the next drive up, what we call the Darvis box, right? So that's what's going on with the S&P. But you can see the S&P has very small bars. See how small the bars are there versus how big the bars are here, how big the bars are here. These YieldMax funds, these guys that sell this premium, this is where they make a lot of money, big money here, right? Big bars, big money. Little bars, little money. So keep that in mind when you're looking at these YieldMax funds or these single stock ETFs that are trading options. They make more money when the market is volatile. So little bars, little premium, meaning little dividend payouts. Big bars, big premium, big dividend payouts. All right, so keep that in mind. So it's not like you get like with a traditional dividend, you get basically the same thing every month. Right? It's pretty much defined, and you're going to get basically the same thing every month. You'll notice that in my portfolio, I've had a month that's gone from $53,000 in one month to a $26,000 month, right? So there's a big variation in there. And then I think they also have reconciliation months where it's like, well, we kind of give you this, and then, oh, we got a big bunch of money, or, oh, we're a little bit short. So they kind of reconcile and then they continue on. You especially see that with the versions of the funds that pay out on a weekly basis. On a weekly basis, let's go back over to my weekly basis. Where did it go? There it is. So if we go over to the weekly payers, for example, YMAX is a weekly payer. You can see it pays out on a weekly basis. They have one week about every 4 weeks. It's just a little tiny number. Sometimes you see it more often than not, but they'll have 1 week that's just a little tiny number, and they have a reconciliation, I believe. I'm just speculating there. I haven't read that anywhere. I just, from my own personal experience, where it seems like every month they seem to have one week that's kind of off, not close to the others. So I think they kind of reconcile. I don't know about that for sure, but that's kind of the feeling I get. So you come in here, YieldMax, just for fun. You can come down here and see most of what they're invested in with this particular fund. This is more of a traditional. This is more of a traditional ETF, exchange trade fund, meaning they're investing it in more than just one stock. Like Tesla's TSLY is just invested in Tesla plus all the bonds. Right. This one here, YMAX, this is a variation. They invested across all of their own other ETF funds. So you can see in here, they've got mRNA, they got Hood, they got Coin, MSTR, NVIDIA, Bitcoin, SMCI, AI options income strategy. They got Google. So this one is actually spread across all of them. So if you're like, well, gee, why do I have a portfolio where I've picked all the different ones? Well, why would you even do that? They'll do that for you. You can just come in and say, well, I just want your top 10. What are your best 10 holdings? They do that and they rotate it. They'll change it up. Whatever's doing better, they put into their YMAX fund. So if you just wanted to do YMAX and have a portfolio built on whatever their top 10 very best funds are, just put it into YMAX. Now you only have to have one portfolio that you trade. You put your money in there, it pays you a weekly payout, and then they do the diversification for you. They'll put it into whatever funds, they'll take your money and put it into whatever funds are doing the best at the time. So they rotate around and say, oh, well, this one's doing really good now. Let's put some of their money over here. Oh, that one's not doing so well. They take it out and they do it for you. So they do the diversification, and they also change it around. They roll it from one to the other, and then they're trading the options on all those funds for you. And that ends up being what they call their YieldMax fund. All right. And then it pays you every month. Now, it's not the highest payer because it's more of a conservative. Now, conservative is kind of a misnomer word, because these are, when you're trading options, you're not conservative, but it's a conservative option strategy that they're using. For YieldMax, this is relatively conservative. All right. For these aggressive funds, it's still a conservative version of the aggressive funds. And you can see that on average, if you go over to their website, let's pop on over to their website. Where did their website go? Here it goes. You come over here, you can see they'll come through and they'll tell you what all of the different returns are for these different stocks. And you can see that the YieldMax fund itself is not the most aggressive. All right. So actually, I think my calculator shows that better. Where does YMax show up on their list? So these are all the ones that they're listed in. I've got them listed by yield. So the highest yield is at the top. NVIDIA is the highest yield. That's when I showed you that. Look, MRNY is the second highest yield. It's 102. And that used to be clear down at the bottom of the list, right? It used to be shitty. Now it's really good. So they change. As markets do more things, they do more stuff. So if we come down to YMax is going to be clear down here somewhere. Where is, I don't even see it in there. There it is right there. So you can see it's considered low to moderate on the risk stage. So that's their YMax fund. And, it only returns 15% yield per year, only. That's a lot of money, 15%. And that's their conservative one for you. They just take care of you for you. They pay it out every month. It's 15%. Put your money in there. That's your UBI right there. Universal Basic Income. Weekly check comes to you every month. Put $100 grand in there. You're going to make $150,000 a year. Or not, 15% of $100,000. You're going to make $15,000 a year on $100,000, and $15,000 a year. That's pretty good money on $100,000. 15% annualized return. Now, can you get higher? Yeah, they got some that are wild and crazy, but they look at the risk over here. Risk is very high. That's what I just lost it. So that's, you're going to, if you build your own portfolio, like I've done, I'm doing better than the YieldMax because the YieldMax is more conservative. They're putting their stuff in more conservative markets, but you could build, the top 10, just take the top 10 right there. There you go. Top 10. Now you've built your own YieldMax fund. You got 10 in the top 10, and away you go. Rich, rich, rich beyond your wildest dreams. It's not completely, set it and forget it. You still need to trade it. You still need to be wise about it. You still need to put your money in there. And I wouldn't recommend you drip it. Now, I've got another article coming out in Pit News Magazine about when to drip. Lan always says don't drip. Does that mean all the time? No. Are there times when you should drip? Yeah, there probably are times that you should drip. I'm not a real big drip fan. All right. But I am a big fan of reinvesting your dividends when they come out. I just think you should be more strategic about it. I think that in this case, in particular, in the YieldMax funds, why take it out if you're just going to put it back in? If you're going to trade the YieldMax funds and you're just going to keep putting it all back in, why not just hold the underlying stock? I mean, if you're going to take Tesla and you're just going to drip the money right back into Tesla, why would you do that? Just go trade YieldMax. Just go trade Tesla. Just go put your money in Tesla, and they're not going to keep taking it out and putting it back in, taking it out, putting it right back in, taking it out, and putting it right back in. That's in this example, that makes no sense. Why would you do that? Now, maybe it might make sense to do that over if you're doing a traditional dividend in something like, I don't know, AT&T or something. You can just drip your money back in because it's kind of, it's a why bother amount of money, and you're just going to put it right back in because it's profits that they're giving you. It's not income that's coming to you from selling premium on options. It's just, we're going to give you a little penny here, and what are you going to do with it? Well, just put it back in. I don't care. And so does it make a difference for you to grow? Yeah, it makes a big difference over 20 years. It makes a big difference. You want to be able to reinvest and drip that money back in. But when you're doing it this way, you get a big old check, 111% return, because you're getting a dividend. Your dividend is not really just a dividend. It's It's a distribution of income that's coming to you from options. Well, you want to be wise about putting that money back in. You don't just want to put it right back into NVIDIA the minute you get it out. Why would you do that? It's illogical. Don't do that. That's a lot of money. Take it, let it sit in your account for a second, and figure out where else you might want to put it, or if putting it back into NVIDIA is the right idea at the point. Because if let's say NVIDIA is coming down, it's in a nice little downtrend, and they pay you a big dividend, and you say, well, I'm just going to drip it back in. You put it right back in. What's it going to do? It's going to compound your losses. Who wants to compound losses? Don't buy a falling market. That doesn't make sense. Come on, people. Come on. Don't reinvest your dividends unless it's some stupid penny that you're going to get from some Apple stock that you're holding for 40 years. You can drip those in. Who cares, right? That's irrelevant. This is a different story. This is trading. This is not, there's a difference between people who trade and the people who invest. When we trade the YieldMax funds, we're trading them. We're not investing in them. All right. We're not buying the underlying stock of ET. We're trading these babies, right? There's a different strategy to it. Now, it's not much, you can't buy and hold it. I mean, kind of what you're doing. But when they give you those dividends and they come in, don't just drip them back in. You got to take them, be smart and wise about when you put that money back in and where you put it in. Just because it come out of NVIDIA doesn't have to mean you have to put it back into NVIDIA, right? And if you're just going to put it right back into NVIDIA, you just as well not take it out at all. Just go buy NVDA. Just go buy this underlying stock. Don't buy the ETF. Makes no sense, right? And usually the reason you're having it come out anyways is because you want to take it out and spend it. You want to live on it. It's income. All right, there we go. Now that's a nice rounded out concept of YieldMax. Now let's go over and look at this new one. Now this is the new company. To stay updated with Granite Shares ETF and to be the first to know about innovative products and science, I'm going to do that. lhturner@gmail.com. So I'm going to add my email in here, and I'm going to subscribe to their little newsletter to stay updated. I just did that. Okay. So this is the new company, Granite Shares. Now, this is as much as I've looked at them. Hello, Matt Lamb. Would you like to talk about your products? No. I just want to look at them. All right. So this is the new company that has been brought to my attention, and they have a series of ETFs. They have leveraged and investing single stocks, which is very exciting. I want to go look at those. But the ones I'm most interested in are these YieldBOOST. All right. YieldBOOST is doing the same thing as YieldMax. Now, you know what YieldMax is because I just spent the last 30 minutes talking about what YieldMax is. YieldBOOST is the exact same thing, but a different company. They now have single stock ETFs, but instead of buying a long call or a bull call spread with a naked leg, they just sell puts on it. All right. They're selling puts. So they're collecting premium from puts. Now, it's a different strategy. Now, I don't know a whole lot about it, but that's what I've understood. So I am going to start doing a bunch of research into this, and you will benefit from that. Mostly what you're going to start seeing is you're going to see articles in Pit News Magazine starting to show up and talk about the YieldBOOST stocks. I like ETF, single stock ETFs that sell, that trade options. I like that. There's some others that trade options. Not as, some I like more than others. Some I like less than others. There's a bunch of different companies that are all jumping on the bandwagon. Jay Petrocelli is kind of the one that kind of started this single stock ETF idea and got it going. And now there's a bunch of other companies that are all jumping on. And this is just one of them. And they seem to be pretty cool. So we're going to go into the list that they have. These are called the YieldBOOST, not YieldMax, but YieldBOOST. So you can tell they're kind of copying YieldMax. So here they are. Here's the ticker symbols. They have an NVIDIA. They have a QQQ. Now, the ones I'm most excited about are the QQQ and the SPY. All right. So they're selling put options on Qs and SPY. Now, they also have a Tesla one, and they also have a Bitcoin. All right. They call it their YieldBOOST Bitcoin. All right, so let's see what the NAV, this is how much they're costing. So the expense ratio, they're more expensive than YieldMax. They're 1.07. YieldMax is 1.0. I've seen YieldMax has one that's 1.02. So these guys are more expensive. These are their YieldMax funds. So NVYY, YBTY, YSPY, TQQY, and TSYY. Now I'm going to take this screen and I'm going to take a little snapshot of it with my phone because I don't want to keep having to refer back to it. Watch this. I'm going to do a cool little trick here where I'm going to just snap that with my phone. All right, so I got it on my phone. I can set it here and I can look at that picture and I don't have to keep referring back to this page. So that'll make it easier on you guys. So I'm not always flipping back and forth. All right, so these are the funds. Now what I want to do is I want to come over here and I've already got them in track and trade. So I've already added them in. So there's some in here. The first one I want to look at is their YSPY. This one is the YieldBOOST SPY ETF. So this is our S&P 500. Now this is, I think they've got one that's longer than this, but you can see they just started back in February. And so I just heard about it today or the other day for the first time. And this is where it's at. Now they are selling. Now, again, remember, this is not the S&P itself. This is the fund that they put the money into and take the money out of to trade options on the S&P. So, and I've noticed this about YieldMax as well. When they first get into these markets, when they first start them, they always seem to have a big flush. And I think it comes, we've talked about this before, I think it comes from not knowing where to kind of start. You know what I mean? They don't really know where their numbers are going to be. So when they first come out, they're a little optimistic, I think. It's like anytime you have an IPO, they always come out and the IPOs always fall, right? Not always, but like 99% of the time, they always flush, right? Here, I want to change this chart preferences on here all the way down to, let's bring that to 1. It's tiny. All right. So they always flush, right? And that's kind of what this is too. But now you can see they kind of got their footing. They kind of like, okay, we figured this out. We're kind of, okay, we're not giving away too much. We're not making, we're kind of figured it out. So they're kind of in this little trend right here. And now what we want to do is we want to look and see what they've been giving out. The cool thing about this is that they're giving out, let's go over to our dividend aversion little calculator. Where is it? It's right here. So the symbol, I don't have all these symbols memorized. So it's YSPY. All right. So you can see they started out doing monthly. And they started out giving $1 per share. And then here they gave 81 cents per share. And then they gave 80 cents a share. Then they went to weekly. Now they're doing weekly is cool. Why is weekly cool? Because if you're going to compound your money, you can compound it 4 times a month as opposed to once a month. So you get to compound more often. And so you can make more money over a longer period of time if you're going to compound your money. A lot of people just compound. They just take the money and put it back in. They drip it in. Now, again, I'm not a big fan of dripping, but I am a big fan of reinvesting. So when they give it to you, I want you to make the decision to put it back in. If you think putting it right back into YSPY is a good idea, go ahead and do that. Put it right back into YSPY. I'm not saying that's a bad idea. I just want it to be a decision that you make. All right. I don't want you to drip, which is a non-decision. Now, if you choose to drip because that's a decision that you've made and you're not just doing it because you don't know what it means or you just thought that's what somebody told you you're supposed to do, that's what I don't want you to do. But if you look at this and you say, well, it's pretty much doing what I want. I just want to keep reinvesting and building my position into YSPY. And you know that you're just going to put it right back into YSPY anyway. You can go ahead and drip because then you can go and if you decide that, oh, the market's starting to flush back down and I don't really want to be, compounding my losses. If this thing turns and starts to come down, you can go turn your drip off. Go turn drip off. All right. So you can turn drip on and turn it back off. So you can do that too. I mean, there's always caveats to every way that you trade, right? But my point is I just want you to be decisive about your reinvestments of your dividends. I want you to know where they're going and do it on purpose. Okay, so this is now you're kind of climbing, so this is nice, and they're paying it out every single week. Now you notice they're coming down when they paid it monthly. Now they're paying it weekly. The volume started to pick up. A lot more people are picking up onto this market, so the volume is quite significantly more than what it was in the beginning. Of course, the more the further into it goes. The reason I like the SPY is because YieldMax doesn't really have an SPY version, something that trades options on the S&P 500. Now they might, I don't want to say they don't. They might have something I'm not aware of or can't remember. So let's come in and do a little math. All right. So we're going to pull up our little calculator. Actually, the reason I wanted to have Grok fix our calculator, it's got 19.4 cents, is because we can. The problem is that I have to go back and forth again. All right. Let's write down some numbers. So I got my little back of the envelope math here. So not back of the napkin, I got an envelope. So back of an envelope, junk mail envelope. So we're going to come in and we're going to write this down. So we're now currently trading. This is SYSPY, and it's trading at $20.35. And the last dividend was, let's just say 19.4 cents or 0.194 cents. All right. So now we're going to come over to our little calculator, and we're going to use this calculator. I hope it works. Okay, so we're going to put in here, our symbol is YSPY. The share price was 20.35, and the dividend amount was 0.194, and it paid weekly. Let's see if our little calculator works. Invested amount, let's just say 10,000, and we're going to calculate. All right. So without reinvesting, with reinvesting, okay, so here's your weekly payout, $95 a week on your $10,000. Every month, they're going to give you $400 yearly. You know what? This isn't telling us our percent gain. I'm going to go in and tell Grok. Grok, I need that column to tell me my percent gain. But it's going to give us 415. So let's come in here every year on our $10,000. It's going to give us, well, it's 49%, roughly 50% return. So that's pretty cool. So we're going to say, we're going to write this down. YSPY is giving us on a $10,000, it's giving us $4,981.73 a year. We'll just do a year. All right. Let's go look at a different one. Let's go look at the QQQs. Now they're trading options. Now they're trading put options on a YieldMax. All right. Now they're coming in here and they're TQQY. So let's write that down. TQQY. So let's first go back over to our calculator. Oh, not that one. Calculator. Let's go back up to our investment calculator. Let's put in $10,000 and look at our list again. So if we are making $4,981, where does that fit in on an annual basis? It would fit in right about 4,981. It'd be right here, just above dips. So right below XYZ, Carvana is a little higher. So it's above Google, it's above Ybit, Feet, it's above Microsoft by quite a significant amount. PayPal, it's above PayPal, Apple, Netflix, Amazon. So it's their fund, the TQQY, would fit into this list right about here, and it has a payback period of 2 years. So it'd take 2 years to get to parity, meaning parity for me is break even, right? So if you put 10,000 in, it's going to take 2 years for it to give you 10,000 back. And then you'd be on the gravy train, right? You'd have all your money back. You have no out-of-pocket risk. Now, if you keep putting the money back in, well, now you have blended money, and you have to take that into consideration in what you're doing, right? But just to get your money back, that's why I have 2 calculations on my spreadsheet that show both. All right, so there we go. So this is the list, and that's where their Granite would come in with their SPY. Let's go look at QQQ. Now, we all know that QQQ has a tendency to be a little bit wilder and crazier market. So what's their symbol for QQQ? Their symbol is TQQY. TQQY. All right. All right. So this is TQQY. Now we're going to come in here and they're doing 18 cents. Oh, that's less. 18, 18, 18, 17. So TQQY, if we know that the SPY was 19, now wait a second. We got to take into consideration that let's do the math because the share price is less. So we're going to come in and they're trading at 1920. We're going to use the lower number, 1925. And they're doing 18, let's say 18.185. So let's go over and put those into the calculator. Thank you, Grok, for fixing this. All right. So we're going to come in here, TQQY, and we're going to say our share price is 19.25, and our dividend amount is 0.185, and we're doing a weekly basis on $10,000. All right, so it's coming in on a yearly at $4,009. Oh, almost exactly the same, $4,997.40. How about that? It's within $10 of each other. Okay, so that's cool. We like that. Let's come over and look at the other one. Now let's go look at their Tesla and compare their Tesla to YieldMax Tesla. So their Tesla is, where is their Tesla? TSYY. TSYY. So we're going to come over here and we're going to look up TSYY. TSYY. I need to have Grok create us a comparison calculator so I can put in TSYY and TSLY and have it compare the two. All right. I'll do that when I get time. All right. So here we go. So this is coming in. The share price is trading at $9.67. And it's giving us, it looks like 24 cents, 25 cents, 30 cents, 29 cents, 30 cents, 30 cents, 25, 24. Let's just say 25 cents. Because this one was a little higher, this one was a little lower. But notice that it's the NAV is still coming down. I don't like the NAV to come down. I like the NAV to go sideways. This is a shitty drawing tool. Sideways or at least up. We like it to go up, right? But they're selling puts, so we do want it to go up. So we're going to go to 0.25. So I'm not exactly sure what their trading strategy is. Let's go do a little research on that and see if we can find out. I know they said they're selling puts, though, whereas YieldMax does calls. Now, the advantage of a call, because they're doing a synthetic long, right, is that you get to make the money between where you enter your call and where you put your sold call. If you're doing a put, you don't get that. You only get the premium of the option. You have no, unless they buy a put. Now, I don't know if they're doing, we're going to have to go find out. Let's finish what we're doing here. I'm getting distracted. So many things to have fun with. All right. So where's our calculator? Oh, it's right here. Okay, so we're going to put in here TSYY, and it's currently trading at 9.67. And the dividend is 0.25. And it's paying on a weekly basis. Now, YieldMax only pays Tesla out on a monthly basis. So we got to take that into consideration. All right, so they are on a 5 years. They're going to give you, $3,000. 102.38. Now, you know what's coming. I'm going to go over to the calculator here, and I'm also going to have Grok put these new Granite funds into this list, right? So it's not just YieldMax. So now we're going to come down and find Tesla. Where's Tesla in the YieldMax list? Right now, this is just YieldMax. Did I just pass it? Where is it? TSL. Wait a second. It's missing. Did it get left out last time we did this update? Oh, no, there it is. It's not as good as I thought it was. I was looking for it up higher. Okay, so it's going to return on a yearly basis 1,237. Oh my gosh. So the TSYY, and I wonder if that has something to do with the fact that Tesla's been doing so crappy. Because Tesla used to be at the top of the list, if you remember. It used to be clear up here, which is why we were recommending it and saying, let's get into Tesla, because it was way up here. But Tesla, ever since Elon became political, his stock has done so shitty. And I'm so disappointed because I was saying, I don't think you'd feel bad if you put your money in Tesla. Now everybody feels bad. It's only going to return 1,237 at the current rate that Elon is working. The TSLY is only returning 1,237 a year. But yet the Granite Fund, which is doing put options instead of call options, is returning 3,102 on the same $10,000. How about them apples? Wow. That's fun to see, isn't it? That's why I was pretty excited about this. I was like, these guys got something up their sleeve. And they're giving it to you weekly, so you can recompound it more than just once a month. All right, let's go look at NVIDIA. So they got NVYY. NVYY. NVYY is trading. Oh, and look, it's going straight up. So it's trading at 27.36, 27.36. And let's see what they're averaging every week. 51 cents, 48 cents, 59 cents, 65 cents, 66 cents, 50 cents, 48, 51, 40, 59. Let's go with 50. Let's go with 52 cents. All right. Kind of an average in there, a little bit low average. 52 cents. So we're going to come over to our calculator. Go up to our dividend calculator. Uh-oh. What's wrong? Oh, there it is. Okay. So this is NVYY. Share price is $27.36. Dividend amount is 0.52. Weekly basis, $10,000. Calculate. All right. So $9,000. Wow. $9,883.04 on $10,000 return. $9,800 a year. $823 a month on your $10,000 investment on NVYY. Let's go look and see how that compares to YieldMax NVYY. Break-even calculator, investment calculator. 10,000. NVIDIA is going to give you 11,000. Oh, YieldMax is better. So YieldMax is giving you $11,000 on NVIDIA, whereas the Granite funds are only $9,883 a year. So Quite a significant difference there. Well, not a significant difference, $1,000 over a year's period of time. It's $100 a month more. So YieldMax beats them on that one. All right, guys, that's pretty exciting stuff, right? Let's go ask. Let's just ask Perplexity. Do we know how? Now I got to get the right name of the Granite shares. There they are. Granite shares yield boost ETFs trading. Do we know how? That's not. Do we know what? Granite shares yield boost ETFs trading strategy is. Are they selling put options? I don't know if I should put that in there or not. We'll leave it in there. Are they selling put options? Granite shares yield boost ETFs follow a distinctive trading strategy designed to generate income for investors. Here's an overview of how these ETFs work. Primary mechanism. They generate income primarily by selling put options on leveraged ETFs linked to various popular underlying assets such as the NASDAQ, Tesla, Bitcoin, and others. Okay. Their fund aims to maximize yield from options premium, targeting regularly, typically weekly distributions to shareholders. Key feature, income focused. Income is produced by selling writing put options for which the ETF receives option premiums. This strategy can be applied on options with a variety of strike prices, ranging from far out of the money to in the money, and with maturities from 1 week to a month. Risk management. To reduce risk from sharp downward price movement, the ETFs often buy put options at lower strike prices, creating a put spread. This limits downside exposure beyond a certain threshold while still collecting net premiums. I like that. That's what I do. Okay. I like that. And the reason I like selling premium with options and put options is because you can protect your downside better than you can with a synthetic long position. If you got a synthetic long position like YieldMax does and the market flushes and goes down, well, you can take a bigger loss because it's as if you own the shares and you're just going to lose money and there's no protection to the downside. This is one of the reasons why I was excited about what Granite is doing, is because they can protect their downside better than YieldMax. Now, they don't have as big of upside, but they have a better protection to the downside. And I have a little saying. I don't know if you guys see it in my spreadsheet. Right there. Where is it? Right here. Look at this. Can you read that? I don't know if you can read that. How do you zoom in? Find. No, that's find and select. How do I zoom in this thing? View. Where's, anyway, I'll just tell you. Zoom in. Can you read it now? It says, the guy who survives aren't always the ones with the biggest wins, but the ones who take the smallest hits. That is such an important saying to me. I put it on my spreadsheet to remind me, Lan, stop chasing the biggest wins. The big guy who survives aren't the ones who take the biggest wins, but the ones who take the smallest hits. That's how important that saying is to me. All right, I put it on my spreadsheet to remind me to stop trying to chase the biggest wins and take the smallest hits. All right, so risk management. To reduce risk from sharp downward price movement, the ETF often put options at lower strike prices, creating put spread. This limits downside exposure beyond a certain threshold while still collecting net premiums. I love that because it follows that little saying perfectly, whereas YieldMax does not. It's been something very concerning to me about the YieldMax funds. The YieldMax funds, if the market flushes, they take a bad hit because they're only long, all right? They are synthetic long. Because of the put writing approach, the ETF's upside is capped, just like selling covered calls, to the collected premiums. If the reference asset significantly appreciates, the ETF will not fully participate in those gains, which is fine. All right, which is fine. If you want to participate in the big growth of the underlying stock, well, put your money in the underlying stock. People are like, well, you're not going to make as much money if you put your money in there because you could sacrifice the upside potential. Well, if I wanted the upside potential, I have that option, don't I? I could just put it in the underlying stock. But I would rather have smaller losses than bigger wins. I'm okay with that. It might not be the strategy that makes me the most money. Okay, if you want that strategy, this is probably not it, because it's capped at the top and it's capped at the bottom, whether you're using YieldMax or whether you're using Granite shares. You're going to cap your profits, all right, because you're using protection. You're going to protect yourself to the downside. Now, again, YieldMax doesn't protect themselves to the downside. Well, they do because they have their covered call. And so if the market falls, the covered call covers the loss to some extent, right? Not the full amount, but to some extent, they're covering their losses with the covered call premium. But in this sense, Granite doing the put options, which is more along the lines of what I've been doing for the last 10 years, right, is you can protect yourself to the downside with a put option if the market looks like it's going to flush, and you've got, I mean, granted, your upside is capped because you're not participating in the upside potential. But if I wanted to participate in the upside potential, I just put it in the underlying stock. I have choices. All right. That's why I say when we trade these, we're trading them. You have to trade them. You don't just throw your money in there and walk away. Not that you can't. You certainly can. But if you want to maximize your potential, you want to be a little bit more wise about how you trade these and take advantage of them for the purpose in which they were intended. Just because we're trading in the YieldMax funds or just because we're trading in the Granite funds doesn't mean that we're going to stop doing our own investing and our own trading into the underlying stocks. You guys all know I like to still trade my own long calls, covered puts, naked puts, all kinds of fun stuff. Still doing all that. And it's in the spreadsheet. I got some right now. I got a covered call on right now that's not part of the YieldMax funds in that strategy. All right, so upside limitations. Because the put right approaches the ETF's upside capped to the collected premiums. We understand that. We know that. We know how this is working because we're options traders. We get that, all right? That's not a bad thing. That's a good thing in the sense that we are thinking about this. If the reference asset significantly appreciates, the ETF will not fully participate in those gains. Okay, I'm fine with that. The put options are generally sold out of the money. Now, this is what I want to know. The put options are generally sold out of the money. Does it say how far? Aiming to keep the likelihood of options exercise relatively low and the ETF's net asset NAV stable relatively to traditional covered call strategies. This is really cool. Comparison with covered call strategies, options writing, put options. Okay, here's the YieldMax ETFs and a covered call strategy, which is what the yield. So this is YieldBOOST versus YieldMax, and that's basically what they're showing us here. Where did it just go? Where did you just go to? You just disappeared me? What happened? Oh my gosh. What happened, Perplexity? I was just getting so excited about what you were going to show me there. How do I go and look at the history? Can I? Is it back? Ah, there it is. We saved it. All right. So options written, put options, call options, income source, options premium on puts, options premium on calls, plus dividends. All right. Upside participation, but they're not, YieldMax is not going to get dividends anyway. All right. They're just getting the call premium. Upside participation, limited due to put writing. So you don't, this is another difference. Okay. This is a significant difference between YieldMax and the YieldBOOST. YieldMax gets to participate in the upside potential because they buy the long call. So they get to make the money on the long call. And they also get to get the premium of the call option. So they get both. The upside participation on a put writing strategy is you don't have any upside potential. You don't have any upside potential. So if the market rallies, You don't get to participate in that at all. This is strictly put option writing, collecting premium, which is fine. We know that. Okay, so we're good with that. All right. Downside protection. Put spreads may help limit downside, whereas a covered call strategy, the YieldMax, little to no downside protection. That's always been something that's bothered me about the YieldMax funds. And I keep asking myself, I wonder, because I know these guys trade, because I've listened to videos, I've listened to interviews, I've listened to guys talk about how these guys do it. And YieldMax is they hold their secrets very close to their chest. They don't tell a lot of, but they have teams. And this is my understanding. There is a team that trades just the Tesla fund, right? There's a team that trades just the Amazon fund. Now, I don't know, because it wasn't clear, if one team can trade like 3 or 4 different funds, manages 3 or 4, but my understanding, the way they do it, from what I've heard, and I may be wrong, this is just me guessing from deriving from hearing the conversations these guys talk, but they have one team that just trades the Tesla fund. All right, so it's the Tesla team. And it's not one guy sitting there going, oh, gee, I think I'll click the mouse today. It's a very systematic process that's basically computerized. All right. But they do have intervention. And that was the point that was being made in this interview, is that they're not totally automated to the point where they can't make their own decisions. And so they have a team that actually watches the system, and they can make decisions that they feel is better than what the system might do. If there comes to a point where they're like, well, what should we do? Should we let the system just trade it, or should we intervene? They can intervene, and they have a team that does that, and they sit there and watch just that one fund. My understanding is that they have one team per stock. So, but again, they may have one team that watches multiple stocks. I don't know about that, but I think it's one team per stock. So if the market looks like it's going to flush, I wonder if they don't have the ability to go in and put a put option in there, do some sort of protection to the downside. I don't know if they do or not. All right. I would like to know that. And I haven't been able to discover whether they do that. But from the way I understand it, no, they don't. All right. They have their covered call strategy, and they do it with long synthetics. So they buy the call and they sell the put right at the same strike price. So the premium that they collect from the put pays for the call that they bought. Therefore, it's a free trade, which is how they get such high returns off of not only the long call, which they're making money on, right, up to and limited by the call that they sell. So that's how they can get more money, and they're going to get more money. They're probably, well, and that's we just saw it right there with Tesla. They make more money with Tesla if the market rises. But if the market falls, I think that Granite will make more money, or at least lose less money. All right. And that's a big part of it too. Losing less money is important as well. So these seeks income in diversified conditions, best in flat or moderately bullish markets. And that's important too. These last 2 points are really important. On the difference between YieldMax and YieldBoost. And that's really, it says covered call ETFs. That's what YieldMax is doing. All right. Standard example structure, standard strategy, sell put options on the underlying ETF or leverage ETF with variable strike prices and maturities. Defensive strategy, which covered calls don't have much of a defensive strategy. The only defense is the premium that they're going to collect from the covered call to help cover the downside. And all it is just like, it takes away a little bit of the sting. It's still going to be like throwing merthiolate on a cut. Sell a put and buy a further out of the money put, creating a spread to mitigate losses. So they're just doing vertical spreads, loss in steep market declines, but at least they can do that. Now, I don't know if YieldMax will do that, and that's the question I have. If a market starts to flush, does YieldMax come in, intervene in their mathematical modeled setup, and try and do some protection to the downside? I don't know. I'm going to say no, because I participated with YieldMax in that big drawdown, and we had some pretty nasty drawdowns. All right. The net asset value of the stock flushed pretty good. I mean, if you go over and look at Tesla for example, but of course you also have NAV decay because they're taking the money out and giving it to you. So it's hard to determine whether that was a loss of funds or whether that was NAV decay, and they're giving you your own money there because they do ROCC too, right? Cash and capital. There's just so many unknowns, and they keep it secret because they don't want people to steal their secrets, right? But I want to know. I want to know what they're doing. All right. In summary, Granite Shares Yield Boost ETFs sell put options on leveraged ETFs to generate income, often using protected put spreads to mitigate risk. Their strategy is notably different from covered call ETFs as it emphasizes put writing for income rather than call writing and seeks to preserve NAV while distributing frequent option premium incomes. The preservation of NAV. That is one thing that a lot of people complain about with YieldMax. Now, we've talked about that ad nauseum, right? About the preservation of the NAV. I'm not that concerned about it because the NAV erosion that you're getting in the YieldMax funds is not necessarily NAV erosion. Is they're taking the money out and giving it to you, and you're going and buying motorcycles with it. That's not NAV erosion. All right, that's motorcycles. All right, that's motorcycle erosion. All right, so there's a difference between NAV erosion and motorcycle erosion. If you have the normal stock, let's say you go in and just buy Tesla, and there is no NAV erosion, right? Why not? Well, because you don't have a dividend that pulls out and gives you the profits from what they made every month. But if you did, let's say you just say, well, every month I'm going to pull out the same amount of money I would be getting if I had YieldMax. Let's say I need $1,000 a month pulled out of my Tesla stock investment. Well, you're going to have to sell some shares to get that $1,000. Ta-da! That's the same thing as NAV erosion. All right, that's what NAV erosion is. They're giving you a distribution, therefore you're getting the money, therefore you're having NAV erosion. It's not NAV erosion, it's motorcycle erosion. It's food erosion. It's house payment erosion. And you'd have the same thing if you're going to try and live off of your shares. The only difference is that if you live off of the YieldMax funds, they never sell the shares to give you the distribution. Yet they pay you the money based on the number of shares you have. So if you're over in Tesla itself or in Apple and you start selling off your shares, eventually you're going to run out of shares. Now that's called NAV erosion in my book. They don't call it NAV erosion, but it's still the same thing, right? If you to get your money out, you have to sell your shares. And I always tell the story, how much ownership of Microsoft does Bill Gates have? He owns 1%. That's all he's got left. Why? Because over the last 20, 30 years, he sold all of his shares. He used to have 100% of Apple, I think. Might have been 50. Might have had a buddy that he came into and did 50-50. I don't think so, though. I think he had 100 shares in the beginning. Now I think he had 100% ownership in Apple when it was little, but he sold all of his shares off, many of them to the public, right, to raise money so he could build a good company. That's what you do. But now he's got a great, big, giant company that he owns 1%. Which is a lot more money than the 100% of a little tiny company, right? But it's not like 20 or 30 or 40%. How much of Tesla does Elon own? I think Elon owns like 20 or 30% of Tesla. That's a lot, all right? That's a big ownership. Bill Gates has sold all of his shares off. He only owns 1% of Microsoft anymore. Not that I feel bad for him. That's still a lot of money, and he's spent it on a lot of things, and he's done a lot of good with it and a lot of apparently things that people are a little bit sketchy on, but that's neither here nor there. I'm not talking about that. I'm talking about you and me. And if you have a trading account with a bunch of shares in it and you need to live off of it, you have to sell the shares to participate in the income. And then eventually you're going to run out of shares. And this is the biggest fear that people have when they have all their money in a portfolio. Right? My uncle, I told you my uncle, he owns gold. He won't sell it. He's 80 years old. The guy's I don't know when he's going to die. Maybe he'll live to 110, and I hope he does. He's my uncle. Love the man. I want him around as long as he'll stay, right? But let's say he's going to live another 5 years. He refuses to sell his gold. Why? Because he's afraid he's going to run out. It's the same thing if you have all your money in the stock, right? You start selling it off. Well, I'm afraid I'm going to run out. How long am I going to live? I don't know. Speaking of that, I have a calculator that calculates how long you're going to live so that we can. I've told you I've been working on this, but the software, Grok wasn't smart enough to do everything I needed it to do. But now Grok 4 has come out. I'm going to circle back around and I'm going to put that in there and we're going to work on it again, see if Grok 4 is smarter than Grok 3. So I have a calculator that calculates your age, based on all of the life insurance companies. Life insurance companies can pretty much predict how long you're going to live down to the week, right? So they can bet on giving you life insurance. So I take those same models and we built those into a program that'll tell us how long you're going to live and then how much you're going to need based on how long the projections are that you're going to live. It's really a cool little calculator. I mean, you can plan your retirement a lot easier if you know when you're going to die. Not that it's going to be perfectly accurate. It's based on, but it's kind of creepy. I know, but hey, why not? Right? Why not? We can guesstimate when we're going to die based on a number of different mathematical factors, based on averages of when people die, based on how they live. And that's what it's all. It asks you a whole bunch of questions. And then it says, you based on the answers you gave, this is the average of what people who do what you do, that's when they die. And so then you can say, well, that's how I'm going to live. And you could go in and say, well, what if I stop smoking 12 packs a day? Well, you can change that. Oh, you're going to live longer. So you're going to need more money. It's like, well, I don't have that much money. This is my brain thinking, right? Well, I don't have enough money to live as long as it says I'm going to. So I guess I better start smoking 12 packs a day so I die before my money runs out. That's Lan's brain thinking. All right. So anyway, we got fun things coming up for us, and I'm pretty much run out of things for today. We run out of time for you, but we could go on forever on this stuff, and sometimes we have a lot of fun, and it's a really good class, and I think today was a lot of fun learning this new stuff, and I'm going to definitely be investing in YieldBoost. I am looking at putting some money in. I want to time it properly, and I'm not going to just throw it all in at once. You know me. It sometimes takes me 3, 4, 5, 6, 7 months to get my money that I want into a certain stock because I want to buy low, sell high. I want to do the accumulation distribution. I want to do the dollar cost averaging. I want to be smart about getting my money in there. But I'm definitely going to start looking at and considering adding some of the Granite shares YieldBoost to my portfolio, and I'm going to start adding some of their stuff. They've got other stuff too, and we can talk about that in another time. In their ETFs, you can see up here they got leveraged accounts, single stock futures. Sorry, Matt Lamb, not interested in your conversation right now. So you can see they got all kinds of stuff in here, and I haven't done any math on it because I come and look at this with you. I wanted my first impressions to be with you guys, and I'm going to come and look at all these too. I want to see what these are. What are they doing here? I don't know. Single stock, leveraged single stock on PDDL. What the hell is that? I don't know. I'm going to go find out. 2 times leverage. I don't know. Are they good? Are they bad? But the point is that if you do these, then you don't ever sell your shares, but you get the distributions from the options premium, and you don't run out of money. Okay. The point is that you don't run out of money. As long as the stock does well. I mean, you still have to have a good stock. You have to be invested in a good company. If the company goes out of business, well, you're going to go out of business too. It's not like it's free money. You still have to work for it. You still have to earn it. Then the company, you do that through the company doing well. Right. So you have to pick good companies, and you have to roll and move around and keep your money, working for you. But you don't want to be rolling and chasing constantly, because that doesn't do you any good. You have to wait and get your dividends and kind of take that all into consideration. But be smart about your investing in these different funds. And the nice thing about these is that they don't sell off the shares, so you don't run out of shares. And as long as the company's doing well and still growing over time, your ETF should do well. All right. And I like the idea of doing puts. I do. I really like the idea of doing puts. So I'm going to start investigating these. Look, they got all kinds of fun things we can look at. So that's the class for today. I do have something I want to talk to you about. Just a second before you run off. We have to sell you something.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right. Now, also, did you guys see Claire's been working really hard? She's been putting out a lot of little podcasts, and she's been having fun with that. So let's have Claire introduce you to her podcast. I want you guys to all go watch her podcast. You can just go over to the YouTube channel. It's just youtube.com/trade mentors. I mean, you don't have to go over to the podcast places and sign up for the podcast, because she just puts them out on the YouTube as well, on our YouTube channel. So this doesn't say that, but just be mindful. You can just get them on YouTube.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pit News on Air. your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang, we're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right. So go check out Claire's podcast. And if you guys don't have Pitt News Magazine, you got to get Pitt News Magazine. That's where I'm going to put all the research and stuff that I'm doing on all this stuff. It all shows up as articles in Pitt News Magazine. And of course,
look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
Or this
Look,
brain.
folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but I didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
All right. Go get yourself Pitt News Magazine. And we're going to put all the research into these new funds in there. And it's only $39 a whole year. And it's all recorded, all the audio, everything. We put a lot of work and time and effort and energy into putting into this thing. So it's worth the $39, I promise. And if it's not, hey, we'll always give you your money back if you don't think it's worth it. All right. That's it. That's all I got for you today, guys. We'll let you go and we'll see you tomorrow. I think I'm working on trying to get a guest speaker for our scalping day trading session tomorrow afternoon. We'll see if he shows up, but come and join us tomorrow afternoon, 1 o'clock power hour. It's 1 o'clock Mountain Standard Time. Make the adjustment for your time. And we'll see you tomorrow afternoon. And then we'll continue this conversation with our stocks investing on Thursday morning. All right, tomorrow afternoon, 1 o'clock. We'll see you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.